I am a manager with KPMG's governance, risk, and consulting, as well as ESG services. I am hosting you once again to this webinar from the UK Ghana Chamber of Commerce. Today's session comes with a different twist because we are not presenting alone as KPMG, but we've been joined by a known and reputable legal firm who happens to be a member of the UK GCC, that's JLD and MB, who also provide some very thoughtful and deep insights on the legal perspectives of some of the things we will present from our end as KPMG. So in a bit, I'll hand over to the speaker who happens to be Gordon Dade. Gordon will present on KPMG's part where he will take us through measuring to reporting, how to communicate our ESG story and impact. And then he'll be followed by a partner from the JLD and MB team. And then after which we will take questions from the participants and also ask some questions and get answers from our presenters. So Gordon, without wasting much time, I'd like to hand over to you to start us off with your presentation. Thank you.
Thank you very much, Ken, and welcome once again to all our viewers and listeners and participants to this session this afternoon. I'm very excited to be with you, and I believe that this session would provide us the opportunity to discuss this very important and topical issue on ESG. I'm sharing my screen at this point, so Ken, if you can see my screen, just let me know. Then I can start.
Yes, Gordon, I can see your screen.
All right, thank you. So the topic for discussion this afternoon is communicating our ESG story and impact and measuring to report. And as we all know, ESG has become very topical, and everybody is really getting interested in the subject area. But what is even important and critical is how we communicate our ESG story to all our stakeholders. And for this discussion or this afternoon session, we are going to look at the key fundamentals of ESG. We look at the key ESG metrics and KPIs and what data collection analysis is all about, what it means to go through stakeholder engagements, engaging all your stakeholders, knowing their needs and reporting accordingly. And then we look at some ESG reporting frameworks and how to do the communication itself. So that will be the order in which the presentation will be structured. Now, in terms of ESG, I know we all have a sense of what ESG is all about. I mean, we've heard the word ESG, and sometimes you want to know what really is this ESG. So ESG is basically environmental, social, and governance. And what does this mean? This basically is a company's or an institution's commitment to achieving these key priorities. So on the environment side, a company or an institution will say, how do we manage our impact on the environment? And this normally is you are looking at the non-financial aspect of the business. Then when it comes to social aspect as well, you also want to look at what are some of the critical issues around the social aspect that is important to your institution. So things around employee health and safety, community relations, human rights, pollution, taxation, all these are critical when it comes to the social aspect. And so as a business, you want to really look at what is your impact in these areas and how are these areas impacting your operations as an institution. Then, of course, the governance aspect, which is also very important, is how are you ensuring that issues around risk management, is being really considered in your operations, your governance structure, and the supply chain management, economic impact, and even the local regulatory and environment, how they all impact your business. But I think when we talk about ESG, the big thing that we all know, that we all hear about, is climate change, and that's prominently feeds under the environmental aspect. But as we move on, you realize that even the other factors like the social and governance are really becoming very important. Now, I think it fits of ESG reporting. Now, based on our KPMG 2022 global, are increasingly agreeing that ESG programs improve financial performance of businesses. And again, when you look at, I think somewhere 2021, the CEO of Unilever, Paul Pullman, who championed ESG initiatives across their whole global organization, was paid about 720 million USD as bonus just for championing that ESG cause. So we realize that ESG really impacts financial performance of businesses. The other thing that we have seen is that ESG prioritization for institutions also impact talent attraction and retention. So based on a research that was conducted by the Bank of America in 2018, 94% of Gen Zs and 87% of millennials are likely to work for companies which have a robust ESG focus. So if you're a company or you are because we all know that talent is very for your business, then ESG must be something that you prioritize. And for a business, issues around environment, your social, your governance, very critical, as I've already mentioned. ESG in your operations also impact employee brand and your reputation. So in 2022, KPMG, for us in KPMG as a global organization, we launched out on a mission to say we are going to measure our ESG story and tell the whole world what we are going to do. And for the past 2 years, the firm has actually invested 1.5 billion USD into ESG initiatives. So when you come to our different offices today, you see different programs that we are putting across to make sure that our people have the requisite experience when it comes to working with KPMG. And we believe that these things are all impacting our brand. In fact, when you look at the brand survey that was conducted last year, our brand seems to be doing well than before. So we are really sure that when you prioritize ESG, it will impact your brand and your reputation in the market. Now, what are some of the metrics or the metrics and KPIs that we normally consider when we are doing ESG assessments? So as I've mentioned, the environment aspects, for instance, you look at things around climate change, energy consumption, renewable energy use, and waste management. Now, let me take my time to take us through, for example, energy consumption. When we say energy consumption, what do we do? What are the different things we do to actually report on that journey? So for energy, you want to track your use and set target for specific reduction program. So if I use KPMG again as an example, since COVID struck and the world, we decided that we were going to even have a working from home arrangement. In fact, before COVID, in Ghana specifically, we had already piloted a program on working from home. So some of our colleagues were working from home even before COVID. Now we realize that when we do working from home, we are able to track the amount of energy that we use in the office in terms of the reduction. So today we operate in 3 different offices. Now, I think on Thursdays and Fridays, some offices are not opened. When those offices are closed, we are able to say, okay, what is the amount of energy that we are going to reduce? Now, this is not just looking at the cost implication to the business, but we are looking at the sustainability, because when you look at the UN definition for sustainability, it's looking at today's consumption, taking a view of what will be there or what will be available for future consumption or future generations. Now, if we consume all the energy that we have today as a business or as a country, what will happen to the future generation that will come? And don't forget that it's projected that the future generation will even live longer than we are living today. And which is why, as a business, we prioritize energy consumption. So, for you out there, you may also want to set specific targets to track your energy consumption, which is very important. Now, again, when you look at waste management, what are the different initiatives you can do to ensure that you are managing your waste and your impact on the environment is really tracked and traced? So for waste, for instance, you can have a recycling plant, or you can have different bins that you use. So if you go to a hospital, for instance, they have a red bin, they have a yellow bin, and they have a green bin. All of them are taking different type of waste. And as a company, as an institution, you can also have that segregation to look at solid waste, to look at waste that you can process or reprocess, or waste that you can actually dispose without any environmental consequence. And that will be a way of tracking your impact on the environment. Now, when we come to the social aspect, things around employee well-being is very important. What policies are you putting in place as an institution to ensure that the people who work for you, their well-being is prioritized? So things around working from home, things around flexible working arrangements, things around maternity leave. Today we have seen institutions where when our ladies deliver or they give birth, they are given more than the 3 months that we are used to. Some are even doing 6 months in Ghana. And we believe that these are things that people must adopt, so that our employees will have a very fair working environment. Now, when you also look at other discussions that are going on, even in KPM today, we have introduced what we call paternity leave. So when you're a man and even your wife delivers, you can also have some time to spend with your newborn. And that is a long way to ensure that you bond with your kid from the beginning. And these are all things that you do to ensure that people are really included in the business that is being run. What about diversity? How do you ensure that your leadership profile, your employee size is diverse? So you have a percentage and a target that you want to achieve. So when you are recruiting, you make a deliberate effort that you want to bring in males or females to achieve a particular target. You are not just achieving the target, but you are trying to make sure that you are being inclusive and giving opportunity to everybody. So as I sit here today in KPMG, for instance, when you look at our management, our staff strength, for instance, we have about 52% males and we have about 48% females. And that tells you that we have been very deliberate about the people that we bring in, making sure that everybody have opportunity to stay and work with the firm. Now, in terms of governance, what are the key metrics that you want to consider? So things around board diversity, as I've already mentioned, is very critical. Things around anti-corruption and ethics. How is the board tracking compliance with anti-corruption laws and adherence to ethical business practice? Now, if you don't track and measure these things, the next thing you will see that as a company, you have been involved in some legal suit or some corruption or corruption allegations, and that can actually bring your business down. So that is why at the board level, you need to put in place mechanisms to track these things and make sure you are measuring. And where you find any potential risk, you put in place the measures and mechanisms to stop them. Now, we will now move on to look at how data collection and management is very critical to your ESG story. To tell any compelling ESG story, you need very credible and relevant data. Now, data forms the foundation for all situational analysis. So, whatever analysis you want to make, you need credible data. Now, how do you go about your data collection? First of all, you have to identify the specific data that you want to collect and confirm the reason for their collection. So, for example, do you want to highlight the number of, you don't highlight the diversity and inclusion in your business? If that is what you want to do, then you look at what are the different sources of data that I can collect and what would this mean as I tell my ESG story. The next thing you want to do is to locate the different sources of the data. So for us, if you want to look at numbers of employees, then we go to the HR department and say, HR, can you give us data on employees and even give us profile of when everybody joined the firm and how long they've stayed? This will help you to understand how you are doing as a business in keeping and retaining your staff. The other thing is to decide on how data will be collected in a secure and accessible and auditable way. So centralizing the data. How do you secure the data that you collect? So if you collect data and you don't make a deliberate effort to keep it in a secure way, you lose it. And today, in the environment that we operate, we have all the malwares, you have all the hackers and all these people around. If you even have an electronic data and you don't put the right process in place, you will lose them. And in securing data or keeping data, you have to ensure that the regulatory issues around data protection are all being adhered to, because whatever data you are collecting must be in line with the data protection law as it is in the country in which you operate. Once you do the centralization, the next thing you have to do is to analyze what are the trends, what are the insights, what is the data telling you? Are you doing well as against the standard that you have set for yourself? If you are not doing well, then it means that you have to investigate and then now look at what you need to do to move your performance forward. The next thing you want to do is to compile a report and then communicate to the different stakeholders that are involved with your ESG journey. So for us in KPMG, every year we come out with what we call our impact plan, update to our impact plan. And when you go to our website, you see data that we have collected, we have analyzed into the different areas that we are measuring. So for us, we measure things around our people, prosperity, governance, and our impact on the planet. If you go to our website today, you find the different things we are doing around all these areas, and that will tell you what we are doing as a firm to move our discussion of ESG to the next level. Now, if you want to engage your stakeholders, what do you need to do? And how do you go about your stakeholder engagement? The first thing you need to do is to identify your ESG stakeholders. Of course, you cannot start engaging the people if you don't even know the stakeholders that you have. So you have to identify the specific individuals, the organizations, and the groups that have a vested interest in your ESG performance. So for instance, for us, our suppliers, our company, our business, our clients are very important to us. So first of all, in beginning our journey as KPMG, we have to now look at what is very important to our employees, and we go through that process through a survey we call the Global People Survey. So when we go through that Global People Survey, it gives us the opportunity to get feedback from our employees to tell us what they really want the firm to prioritize. And as an institution, you need to find the key stakeholders that impact your operations. If you're a mining company, for instance, then your stakeholders will be the host community, your employees, your suppliers, and any other person in the value chain in your operations. If you're a bank, your stakeholders will be your customers, your investors, the people who bring money to your bank, and any other person that also takes money from you. How do you put in place mechanisms to track what the ESG priorities, and then communicate to and then engage with them? After you identify these stakeholders, the next thing you want to do is to conduct a stakeholder assessment. Evaluate the concerns of each of them. So you have identified that your employees are very critical in your ESG journey or ESG story. Now, what concerns do your employees have? What do they want you to prioritize in your ESG story? What are your customers looking for? What do they want you to do as a business? Once you know these things, that will help you to know what you need to prioritize as a business. You then have to understand their unique perspectives when it comes to your environmental policies, your governance issues, and social issues. For instance, if you determine that one of your stakeholders is the government, and the government, in this case, the government of Ghana, taxation is a very critical issue for government today. And therefore, as a business, you don't want to expose yourself to paying of penalties and interest. So when you are doing your ESG story on the social side, you want to see what is government tax policy today? What's the drive towards tax revenue? What are they doing? And then how do you also ensure that you operate sustainably such that you are not overly exposed to taxes that will take your money out to pay interest and penalties instead of paying returns to stakeholders or your shareholders? So that is very important. After doing the stakeholder assessment, the next thing you want to do is to establish a stakeholder engagement plan. So you develop a tailored engagement plan to engage each stakeholder, group them based on their insight. Based on the insight you've gained through the assessment. Your plan should outline specific strategies, channels, and objectives for engaging with each stakeholder that you have identified. So you need to have a plan. Do you want to do a focus group discussion with them? Do you want to do a survey? Do you want to do a questionnaire? Do you want to do like a webinar or something like this, just to make sure that you're engaging with all of them and getting them on board? Again, after you've gone through, after you've identified them, you have done the assessment and you have had the plans, the next thing you want to do is to continuously engage them. So you don't achieve so much if you don't continuously engage your stakeholders in the process. The engagement process is continuous because your ESG story would evolve continuously over time. What you measured yesterday will change with time, and therefore you need to continuously engage your stakeholders to tell them the story, to tell them what you are doing and how you are improving and you are performing going forward. Now, ESG has become so topical and so important, and because of that, we have seen a number of frameworks and different standards that have come out that are being used to do the assessment. So over the years, before in recent times, the IFRS and the ISSB have issued what they call the S1 and S2, and this will take effect from 2024, January 2024. Now, what does this mean? It means that businesses are now being forced to report on their sustainability issues. In the past, as a business, your interest and priority would only lie in reporting on your financial numbers. But today, from 2024, businesses are now, if you report on IFRS, then you are now being pushed to report on some of the non-financial issues that affect your business as well. But before S1 and S2, there were some dominant standards that businesses were resorting to, especially when it comes to funding organizations. So most institutions, when you are going to go for some funding, and I have gone through that process with a lot of investors, what normally will happen is that they will tell you, okay, before we give you this funding, or as part of the process of evaluating you or preparing you for the funding, go through an assessment and measure your business according to some criteria or some standards. And the dominant standards that we have seen so far that are being used is the Global Reporting Initiative, which is the GRI, the SDGs, the TCFD, and then the Broad Sustainability Accounting Standards. These are the various standards that are used to measure, your performance when it comes to the ESG. And I think the other ones like the Equator Principle and the IFC standards and others. And now to talk about Ghana, in Ghana, so far we've seen two standards that have evolved and have come up. And the first one that came up is the Bank of Ghana sustainable principles. So the sustainable banking principles, where banks are now being charged to report on their ESG priorities. In that standard, banks have been given some mandates to look at prioritizing some 5 industries when it comes to lending to them and their dealings with them. So very soon it will become a mandatory standard that the banks must adopt. Then again, I think last year or so, the Ghana Stock Exchange also introduced what they call the ESG manual, and that is going to be a guidance for all the entities that are listed on the best in Ghana. So you see that globally, all these GRI and TCFD and the Equator principles that were coming up. I mean, Ghana have also come up with this too, and I can confirm that the stock exchange manual is actually based on the GRI principles. And therefore, if you're already adopting the GRI to do your reporting, it will not be so different going forward. Now, from a KPMG perspective, we have also seen that the GRI, the TCFD, and then the SDGs are the ones that are being used. Now, about 96% of global 250 companies that we surveyed, are already reporting on their ESG priorities using the GRI and the TCFD standards. And this is very important because we need to know what is happening in the global market and how it applies to us in Ghana. So if you see the regulators coming with new regulations, it's not because they want to bring some new compliance burdens to businesses, but that's where the world is going. In fact, about a month ago, KPMG did what we call a pre-budget survey. And in the survey, we also found out that a lot of businesses are even reporting already on their ESG journeys, and they even expect the government to prioritize this ESG reporting in the next budget that will be read somewhere 15th of this month. Now, based on the work that we've done so far as KPMG and our experience in the market, we have already seen some challenges that businesses, go through when it comes to compliance to ESG. The first one is data availability and reliability. How available is the data that you want to report on and how reliable it is? So, as a business, you want to put in place mechanisms to ensure that data for measuring and reporting on what you are doing is available. Now, the other thing is that it's very difficult to even understand the frameworks the frameworks that are being used. So, for example, whilst we KPMG, when we look at our impact plan, we are using the World Economic Forum standard, or the World Bank standard. Okay, that's what we are using to measure our impact. Others will be using TCFD. Others will be using GRI. Others will be using Equator principles. And even if you come to Ghana, some may even be using the banking principles. So you see that there are different standards that are being used. Therefore, there's no consistency and comparability. But I think what is important is that as an institution, once you decide and determine that you are going to use a particular standard to report on your ESG priorities, you need to stay with it and be consistent. So that over a period of time, you can tell a good story of the journey and where you have come from, what you have done so far. There's also sometimes complexity in selecting the scope and boundaries of your measurement. So how far can you go when you start your journey in terms of measuring, for example, your impact on the environment? How far can you go? Can you look at your immediate environment in terms of your suppliers, or can you go even beyond your suppliers and look at the people in the chain? So others will be talking about scope 1, scope 2, scope 3. Do you want to start with scope 1, scope 2, or scope 3? These are, things that you need to decide as a business and report on. The next thing is some entities engage in greenwashing. So, what is greenwashing? Greenwashing is just touting what you are not. So, for example, you would have heard people saying that we are a green business, but when you go into this business, they are not green. Some will say that when our business, our buildings are green. They are built on green belt, but really, when you enter those buildings, they are not green belt. In fact, they don't even have anything ESG about them. You will not even find the basic thing like a fire extinguisher in that building, or you not even find an access route even for people who are disabled. And when you talk about ESG, these are all things that falls under the social aspect, which are very important. So you find out that a lot of institutions engage in greenwashing, and these are things that if you want to really have a compelling story, you must avoid. Now, the other issue of reporting guidelines, which are not being mandatory. So people decide to do what they want to do. But as I did mention, Ghana have already introduced two. And very soon it's going to be mandatory for some of the institutions. But today, all over the world, it's not mandatory. It's more of people selecting. But again, with the ISB coming up with the standards S1 and S2, we are going to see it becoming compulsory with time. Now, what are the best practices that are available for us to consider in reporting and telling our story? First of all, we need to link sustainability to your overall business strategy. Your sustainability story must not stand on its own. It must be fused into the whole business strategy so that everybody is aware of what you are doing. You must also set clear and measurable targets. For example, if you say carbon emission or if you say carbon reduction, what are you going to do? So for us in KPMG, we are saying that we want to be a net zero business by 2030. What does this mean? How do we track our footprint? How do we track our footprint on the environment? So today, even when it comes to travels, we are looking at, is it a critical travel, is it a necessary travel or not? If it's not critical and not necessary, you will not travel. If you have to do the program virtually, you do it, because as you travel and move around, you are also leaving a negative impact by way of carbon emission onto the environment. So these are very important. You must set those clear goals and measurable targets. Again, you have to involve your stakeholders, as I've already mentioned in the previous slide. And then you provide the context and benchmarks to compare your performance against industry standards. So whatever you want to measure, which people are you going to compare yourself with? So in KPMG, for instance, we are comparing ourselves with the World Economic Forum targets. So what are businesses comparable to us? What are they doing? We try to measure our impact story and compare it to what others in the same industry are doing. If you are doing well, you will see. If you are not doing well, you also see. So as a business, you want to look at what are the competitors doing in this industry and what can you do to also make an impact in where you find yourself. The other thing is that you need to consider obtaining a third party assurance person to help you to enhance your credibility. So the issue of greenwashing is there. People would even say that what you are saying is not true. So you need to get an assurance party to come in to review and assess that what you really said you will do, the goals you have set, the targets you have set are really being measured and you are really meeting them as it is. And once you go through all this process, you periodically report to the public or to your stakeholders to provide consistent updates on your sustainability journey. Now, your report that you will do should be accurate. You must make sure that it doesn't have errors. You must be timely. So just like a financial statement, you are supposed to do it after your financial year end. Make sure that you set clear goals and clear times for reporting. It must be complete. It must cover all the areas that you said you are going to cover. It must be verifiable. So whatever information you are putting there, the source must be there so that you can reference to it. Then, of course, there must be comparability and the context in terms of the benchmarks that you are measuring yourself. They must be clear. You must not use vague words like we are a green business. What does it mean to be green? Show the clear things that you have done as a business to become a green business. Now, how do we then integrate all these things I've said in our story? First of all, you must commit to achieving something. If you don't commit to achieving anything, you will not have anything to communicate. So first of all, you need management commitment, you need leadership commitment from the top. So the board must own the whole ESG process. The next thing you need to do to communicate that story is to do what we call materiality assessment. So as a business, which areas are the risky areas that you want to focus on? Which areas are really important for you to focus on to tell your ESG story? Once you assess that, then you channel all your effort to that area. So you ESG, the environment is important, the social is important, the governance is important. But how do you pick a particular aspect of each of them to then say we are going to really put our effort in this area to make sure we get some traction? And that is where materiality assessment is very important. Then, of course, you then do what we call the integrated reporting. So reporting both your financial and non-financial and see how the trend is coming up and what story is telling you as a business. Then, of course, once you go through this, you go through the narrative storytelling. Tell the story to the public. Tell them what you have done. Explain your vision as a company, your goals, your achievements, and the challenges that you've gone through to achieve the goals that you have set for yourself. Then after doing this, you must be transparent about your ESG challenges and areas where you need improvement. So for us in KPMG, we are saying that we want to achieve diversity and inclusion. As I've mentioned, we are 52% male and then 48% female in the whole organization today. But as you move towards the leadership, the top level, we then see the percentage being skewed. We have 33% female, and we have about 67% male. So you must not hide this. You must still communicate this and make sure that those challenges are being resolved, and you find ways of making sure that you are getting results also there. Now, once you have done all this, you must establish a feedback mechanism. So if you go to our website, there's a place that we have dedicated to people giving us feedback on what we are doing well and what we are not doing well. And as a business, I think feedback is very critical to whatever you do in this ESG journey. So this is one area that you must really consider. Now, I would want to pause at this point and say that for KPMG, we see ESG moving across 4 journey. You have to go through a transformation, you have to go through a reporting, you have to go through things around sustainable financing, do an ESG risk and opportunity compliance assessment. And these are things that we can support you with if you want to begin that journey. And the last thing we also do is looking at the ESG assurance bit, where we help you to tell your story and confirm what you really have done in your operations. So Ken, thank you very much for having me today on your program. And I'll pause here for any questions or thought, or I'll make way for the other presenter. And then when we are done, we can pick the questions. Thank you very much.
Excellent, Gordon. Thanks for giving us these very deep insights into ESG, the things we have to do, the things we should be wary of, so we don't fall foul of this very fundamental ethical issue when it comes to reporting that has to do with greenwashing. So next up is another presentation by Lily Akwe, who happens to be a consummate lawyer with several years of experience. She brings to this discussion some level of dynamism, a deep perspective into an area that KPMG did not cover. So as I said earlier, today's session is pretty different, and we are adding more value to what we started off from the last session. So I'll hand over to Lily to take us through the deep insights she has prepared for us, after which we will ask the presenter some questions and then open it up for our attendees and participants to also ask some questions as well. So the chat box is open. You can post your questions there, and then I'll read them for you as well. So Lily, over to you.
Thank you, Ken. I will proceed to share my screen. Okay. Good afternoon, everybody. So I will be touching on the legal aspects of ESG in Ghana particularly. And my name is Lily. I'm a partner with JLD and MB Legal Consultancy. We're a corporate commercial law firm. And my focus this afternoon will be on the legal aspects of ESG. I'll start by asking a question. Did you know that every company in Ghana is required to consider ESG in its decision-making? And this applies to all companies incorporated in Ghana, so under our Companies Act. And it's regardless of size, regardless of industry, because we usually tend to think that ESG applies to the companies that have an impact on the environment, sort of like the extractive industry sector and the finance sector. However, I am here to tell you today that all companies must consider ESG in their decision-making. So what does ESG mean to you? Is it a measure of the resilience of your company? Is it a nuisance, particularly when you have to court investors and they have a long list of ESG compliance requirements, or you need to submit bids and they're asking you to submit your ESG policy and your sort of anti-corruption, conflict of interest policies? Regardless of how we feel about it, really, ESG is here to stay. And in fact, to a certain extent, it has been with us for a while, but it's been in fragmented form. It appears now that a formal name has been put to it and it's become trendy, but it's been with us, albeit in fragmented forms. I must make this disclaimer. This is not intended to constitute legal advice. We're just looking to provide you with information to pique your interest and to enable you to conduct an assessment of your organization for ESG risks. So please do seek advice in terms of you and your organization's peculiar circumstances and peculiar needs. So on the screen at the moment, you'll see some recent headlines. IFC to strengthen ESG practices in Ghana's private sector, We are prepared to publish our first ESG report, and that's from the GNPC, which is our national oil company. Banking sector embraces ESG principles. CIB to build capacity of financial sector players on ESG. Boosting global competitiveness of Ghanaian companies. The GSE introduces ESG disclosures guidance manual. So it's clear that ESG remains a matter of concern and significance. I know Gordon started off by providing sort of a brief explanation of what ESG is, but I'll also provide a recap, and we'll cover the fundamentals in terms of the existing laws and legal requirements. So I have 2 pictures on the screen at the moment, courtesy of Practical Law and Denson's law firm. They provide detail in respect of the 3 pillars of ESG, which you know are E for environmental, S for social, and G for governance. The environmental pillar includes matters such as climate change, energy efficiency, and land use, and it's a measure of the impact of a company on the natural environment. Then there's the social pillar, which refers to the impact on people, such as employees and customers, and the community in which a company operates. The social pillar includes matters such as human rights, workplace diversity and equality, and community impact. Then there's the governance pillar, which covers matters such as anti-money laundering, board independence and diversity and structure, and sanctions. And that mainly has to do with how a company is run with respect to board diversity, internal controls, and audits. So in summary, really, ESG is a measure of the sustainability of a company, how it is run, and its impact on the environment, on people being made up of sort of the community, its employees, its other stakeholders, sort of like shareholders as well. So currently in Ghana, there is no all-encompassing ESG law. You won't go into our law books and find a law called the ESG law, the ESG requirements. But there are a number of laws and regulations and directives that govern aspects of the 3 pillars. And I know some of the companies on the call right now will be aware of some of them. I think companies tend to think that you have to be a big company in one of the major sectors for ESG and the ESG legal requirements to apply to you. And so, for example, if I'm not in the extractive industry or the financial sector, then I shouldn't worry about ESG and it doesn't apply to me. So I will start with what may be considered to be laws of general application before touching on some of the regulated industries. For the governance pillar, one of the basic laws that apply to all companies incorporated in Ghana is the Companies Act. It was enacted in 2019, it's Act 992. It applies to all companies regardless of size. So far as you're incorporated here, the Companies Act applies to you. So it sets out a number of rules and regulations regarding governance of a company. For example, it provides for qualification and disqualification of directors for appointment. For example, per section 173, the following are not qualified to be directors. And these are persons adjudged to be of unsound mind, undischarged bankrupts. And then there's section 177, which pertains to court orders made in respect of persons convicted of an offense involving fraud or dishonesty, offense in connection with the promotion, formation, or management of a body corporate, offense involving insider dealing, and other criminal offenses which are not misdemeanors, meaning serious criminal offenses, if I can put it simply that way. I think we can understand the reasoning behind these disqualifications, because if you've been convicted of an offense that involves fraud or insider dealing or the promotion or formation of a company, it's difficult to entrust you with the running of a company. So these are disqualifications of directors. And there's section 143 as well, which cautions auditors of companies to avoid conflicts of interest in their dealings with companies. There are also extensive provisions in the Companies Act regarding duties of directors. And section 190 provides that a director of a company stands in a fiduciary relationship towards the company and shall observe the utmost good faith towards the company in a transaction with or on behalf of the company. So I began my presentation by saying that all companies must consider ESG in their decisions. And I will now refer you to Section 190 of the Companies Act, which requires that a director shall always act in what the director believes is the best interest of the company. And in doing so, shall have regard to, and pay attention here, A, the likely consequence of any decision in the long term. So directors must be forward-looking. They can't just look at the short-term implications of a decision, but they must look at the long term as well. And then B talks about the impact of the operations of the company on the community and the environment. And these are the actual words from the Act. And so we've got community, which would be the social pillar of ESG. And we've got environment, which is the environment pillar of ESG. And then there's C, which talks about directors having regard to the desirability of the company, maintaining a reputation for high standards of business conduct. So that can also go into the governance pillar of ESG. Now, if these sort of requirements are not ESG requirements, I really don't know what we would classify to be ESG requirements. And remember that the Companies Act applies to all companies incorporated in Ghana. And I've got the slide up that sort of gives you the A, B, and C that I've just talked about regarding decision-making by companies. So Act 992, which is our Companies Act, also sets out what information should be contained in the financial statements of a company. And it requires that matters such as emoluments of directors, amounts due from directors, particulars of entries in interest register, and corporate social responsibility of the company and amounts spent on CSR during the financial year be reported. And so you have to report all these things in your financial statements. And we can sort of, not contrast, but compare it with the UK Companies Act 2006. And I'm sort of picking the UK because this is the UK GCC, it's the UK Ghana Chamber of Commerce. So the UK Companies Act, together with related regulations and their listing rules and their disclosure guidance and transparency rules, all require companies to report annually on environmental, climate-related, and other non-financial matters, such as social or employee matters, in their directors' reports, their strategic reports, and elsewhere in their annual reports. So it's not just a local requirement. And I know because it's the UK Ghana Chamber, there's a number of companies who would have group companies spread all across the world in other jurisdictions as well. So as you're looking at the legal requirements locally, please bear in mind that there will be legal requirements in other jurisdictions that will also affect your ESG reporting and ESG considerations. So we've dealt with the governance pillar with a law of general application, which is the Companies Act. And I'll bring you now to the social pillar. Let's consider the social pillar. And for this, we're talking about the Labour Act 2003. That's Act 651. And that's relevant, and that applies to all companies as well. So far as you're an employer and you have employees, it applies to you, except certain sort of specified exceptions, which really relates to the security agencies. So once you're a company and you have employees, the Labour Act applies to you. And it contains provisions on protection of employment, protection of remuneration, protection against discrimination, and provisions on occupational health, safety, and environment. So for example, Section 10 of the Labour Act states that the rights of a worker include the right to work under satisfactory, safe, and healthy conditions, receive equal pay for equal work without distinction of any kind, have rest, leisure, and reasonable limitation of working hours and period of holidays with pay as well as remuneration for public holidays, to be trained and retrained for development, and to form or join a trade union. So we'll go to Section 14 of the Labour Act as well, which prohibits an employer from discriminating against a worker on grounds of gender, race, color, ethnic origin, religion, creed, social or economic status, disability, or politics. That's quite a wide encompassing sort of list of things that an employer cannot discriminate against. So this goes directly to the social pillar of ESG, and to employees who work for companies. There's section 68 as well, which has equal pay for equal work. And then we come to the health and safety provisions, which can be found under section 118 of the Labour Act. So it starts by saying that it's the duty of an employer to ensure that every worker employed by him or her works under satisfactory, safe, and healthy conditions. And it lists certain things that an employer must do. For example, an employer shall provide and maintain at the workplace plant and system of work that are safe and without risk to health. An employer must ensure the safety and absence of risks to health in connection with use, handling, storage, and transport of articles and substances. An employer must take steps to prevent contamination of the workplaces by and protects the workers from toxic gases, noxious substances, vapors, dust, fumes, and the like. And there's one that is quite basic, but it's documented in the Act and employers must comply with. And it talks about employers providing separate, sufficient, and suitable toilet and washing facilities and adequate facilities for storage, changing, drying, and cleansing from contamination of clothing for both male and female workers. They must also provide adequate supply of clean drinking water at the workplace. And so if your workplace doesn't provide clean drinking water as a basic, you're already in breach of the Labour Act. Did you also know that the Section 2 of the Public Procurement Act enjoins the Public Procurement Authority to ensure that public procurement is carried out in a fair, transparent, and non-discriminatory, environmentally and socially sustainable manner? So, and that's one of general application as well. I know a number of the companies like to contract with or supply government agencies, state-owned agencies, and covered entities. Just bear in mind that if you intend to bid for contracts with these agencies, you will likely be called upon to provide your ESG credentials during the tender process. In terms of CSR, I wanted to touch on that because particularly for the extractive industry, you will see that a lot of the mining companies and the oil and gas companies have that as a given, as part of their operations. It's not necessarily currently documented, but it's something that is expected by the regulators and by the government anyways. I mean, we understand that there's sort of thought around or consideration around enacting a policy of sorts or regulations for the mining sector at the very least in terms of CSR. But while not mandatory or not necessarily found in a law at this point, it's an expectation and it's unlikely any mining company or oil and gas company is able to operate without having some CSR initiative in the communities in which they operate. So we'll move on to the environment pillar. And that's got the basic overarching one, which is the Environmental Protection Act and the Environmental Assessment Regulations, both enacted in the 90s, pardon me. Which is why I say ESG has been with us for a long time, except that it hasn't been called ESG in the past. And so it may be that we're missing some of these requirements. Regulation 1 of the Environmental Assessment Regulations stipulates that no person shall commence any of the undertakings specified in there unless prior to commencement they've been registered by the EPA, which is the Environmental Protection Agency, and issued with a permit. Also, no person can commence activities in respect of any undertaking which, in the opinion of the EPA, has or is likely to have an adverse effect on the environment or public health unless they've been registered and issued with a permit. The undertaking is quite extensive. There's a whole list of different companies and industries that require environmental permits. They include your usual agriculture, fishing, logging, mining, oil and gas, quarrying, and the manufacturing sector as well. Lists beverages, manufacturing of plastic products, textiles, paper, and then the construction industry. So requirements for obtaining an environmental permit include an environmental impact assessment, and then following the grant of a permit, you're required to have annual reporting. I mean, Gordon from KPMG has touched on reporting in various shapes and forms, but there's laws which have mandatory reporting requirements in them. And so that's aside from you deciding that you're going to be a good global citizen or local citizen and report on your ESG credentials. Companies which have been granted an environmental permit are must report annually on their operations and their effect on the environment. I'll also bring in the UK's Environment Act, which was enacted in 2021, which has provisions which seek to increase the onus on large UK businesses to ensure that local laws are complied with to prevent them from using commodities derived from illegal deforestation from their international supply chain. And so for that, although it appears to be a local sort of UK law, their companies are required to look outside that jurisdiction and make sure that their dealings outside the jurisdiction are also environmentally friendly and don't affect the environment negatively. I mean, as we know, the extractive industries are clear candidates for environmental regulation. And in addition to the environmental laws discussed, which are the EPA Act and the assessment regulations, the laws governing the oil and gas and the mining sectors also contain provisions which seek to minimize the impact of those activities on the environment. For example, Section 81 of the Petroleum Exploration and Production Act 2016, it's Act 919, stipulates that a licensee, a contractor, a subcontractor, or the GNPC, which is our national oil company, undertaking petroleum activities shall take necessary measures to ensure that petroleum activities are conducted in a safe and secure manner, free from accidents, waste dumping, and pollution. Then there's also Section 18 of the Minerals and Mining Act, which is 2006, another oldish act, Act 703, which states that before undertaking an activity or operating under a mineral right, the holders of the mineral right must obtain the necessary approvals and permits required from the Forestry Commission and the EPA for the protection of natural resources, public health, and the environment. Both sectors actually also have regulations which are health, safety, and environmental regulations, which have extensive compliance requirements for those sectors. And then we'll touch on the financial sector as well. So unlike the extractive sector, the financial sector may not necessarily be an obvious candidate for ESG considerations and regulation. However, as the drivers of economic growth, the increased interest in whether companies operate sustainably and ethically has affected companies in the financial sector, including banking, insurance, investment companies, not only in terms of their own operations, so looking at whether they are in compliance with ESG requirements, but also with respect to companies that they work with or they invest in. A few years ago, for us as a law firm, it was not very common to see banks and investors, funds, and the like include ESG considerations in their transactions. But increasingly, we're seeing ESG compliance and requirements present in transactions on which we advise. Investors are consciously investing in companies with excellent ESG credentials and companies that have demonstrated that they operate in a sustainable fashion and are aware of their impact on the environment, their people, and their communities. So we're seeing more and more having to do diligence on companies that you've got investors for, and the investors will have a long list of ESG requirements or compliance requirements that they require the companies to work with. A number of investors and funds as well have made funds available to banks for on-lending, specifically on green projects or projects underpinned by sustainability, ethics, and diversity. So DD undertaken by investors include diligence on ESG credentials, and this is where a company's ESG reporting becomes important. I mean, KPMG has covered that in quite detail, but it's clear that if your company is better off having had a history of ESG reporting that an investor can draw on as publicly available information and is verifiable in order to make a decision to invest in your company. If you have that, it's easier for them to make a decision rather than having to come in and try and find or sort of now put together your ESG credentials and your ESG stories. And also because ESG is important as a marker of the resilience of a company. And so the more emphasis that a company places on the three pillars that form ESG, which again are environment, social, governance, the more likely it is that the company will be resilient and will withstand external shocks better. I think recently, well, a couple of years ago, 2021, there was a downgrade of Ghana's sovereign rating by Moody's. And one of the considerations for that was our ESG score, which the rating agency found that affected our rating. It was a matter of, I think, our resilience in terms of environment and social. And so these ESG considerations are not only important for companies and entities, even at the sovereign level, they can affect your rating, your operations, your attractiveness to investors, and affect your rating in that way. So we'll look at the banking sector. Recently, following the 2018, 2019 issues in that sector, the Bank of Ghana issued a number of directives for the regulation of banks, including the Corporate Governance Directive for banks, savings and loans companies, finance houses, and the like. This was late in the year in 2018. I think it was December, if my memory serves me right. Now, it goes directly to the governance pillar of ESG, and the objectives of the directive are stated to be to require the institutions to adopt sound corporate governance principles and best practices to enable them undertake their licensed business in a sustainable manner. As well, to promote and maintain public trust and confidence in the institutions by prescribing sound corporate governance standards, which are critical to the proper functioning of the banking sector and the economy as a whole. I mean, it does make you wonder that if these directives had been in place previously, would it have minimized the effect of the crisis, or would it even have eliminated the crisis at all? It's a question to ask. The Corporate Governance Directive provides for director qualifications, board composition, providing for independent directors, separation of powers, succession planning, management oversight. It's quite detailed and encompassing. It requires the board of a bank or an SDI, such as a savings and loans company, to monitor and ensure that the actions of senior management are consistent with the strategy and policies approved by the board, including the risk tolerance, appetite, and risk cultures. So in order to do this, the board will have to enact these policies and make sure that management is actually working with and implementing this. SEC, which is the Securities Exchange Commission, which governs the securities sector, also has a corporate governance code for listed companies, which was promulgated in 2020, and also has compliance requirements for boards, risk management, conflict of interest, and the like. There's also the insurance sector, which has the NIC's composition of boards guidelines, which is also a governance directive, which goes to the G pillar in ESG. There's also various guidelines. For example, the banking sector has a sustainable banking principles issued in 2019 and endorsed by the banks in Ghana. I think Gordon touched on that, so I won't spend too much time on that, but they include principles to promote good environmental, social, and governance practices in the internal business operations of banks. In the capital market sector, in recognition of the important role of ESG, the Ghana Stock Exchange as well issued the ESG Disclosures Guidance Manual, which guides how companies listed on the GSE can collect, analyze, and publicly disclose important ESG information using an approach that meets international standards. As Gordon said in his presentation, that guidance manual is based on the GRI, which is the Global Reporting Initiative, and it includes reporting principles, including which sort of advocate accuracy, balance, clarity, completeness, and verifiability in reporting. I think these are quite self-explanatory, and companies operating in the sector, if they're not aware of these at the moment, I'd be very surprised. Financial institutions also have enhanced anti-money laundering reporting to their sector regulators. There's also the Anti-Money Laundering Act 1044, enacted in 2020, which has a list of what they call accountable institutions that must comply with anti-money laundering rules. And these include dealers in motor vehicles, real estate companies, pension funds, fund managers, and to an extent, even law firms. There's anti-money laundering reporting required to be done for that as well. I mean, that is sort of a brief look at the legal requirements for ESG and ESG reporting in Ghana. Like I said before, companies need to be aware of these, but also for other jurisdictions in which they operate, particularly for our chamber, which is quite an international chamber, having been the UK and Ghana Chamber of Commerce. Don't just look at your Ghana requirements, make sure that you're aligning them or integrating them with your international requirements as well, and that your reporting is comprehensive. Carry out your risk assessments, like Gordon said. We advise our clients usually to be intentional and deliberate about their reporting. There's legal reporting requirements, which you have to bear in mind. And also, a lot of the time, they adopt some of the international reporting standards as well. Try and be ahead of the curve. Make sure you're in control of the ESG story, because if you leave a vacuum out there, somebody will fill the vacuum with information that may not necessarily be information that you want out there. So our companies need to be ahead of the curve and to make sure that they're controlling the narrative. They are consistently publishing their ESG credentials and reporting, and making sure that they've got a good history of ESG information and telling their own story. I think I will pause with the legal requirements here, and Kenneth, I think we'll probably take questions now.
Excellent, Lily. I think that was a deeply insightful section. And I believe right now people will now come to accept that the discussion around ESG is not something that has just come up. It's really been with us. And as Lily said, it's been fragmented. We've been doing quite a number of them already. People did not even know that directors of businesses are required by the Companies Act 992, to be wary of the impact their businesses have on the environment based on the heads of directors. So thanks so much, Lily, for enlightening us on this perspective when it comes to the ESG discussion, a dynamic one. So I will take some questions from the participants as well. So whilst I await that, I have some questions to throw to our speakers. So Lily, since you just finished speaking, maybe I will give you the first set of questions to respond to. You know, considering the fact that ESG reporting also comes with some ethical issues, are there any legal risks companies stand to face should they misreport or mislead on their ESG reporting, particularly in Ghana?
Yes, if you're not reporting, you're basically telling lies. You're misreporting, misrepresenting information. And so that can be a basis for a litigation risk. You can be sued by various stakeholders, whether it's your shareholders or activist investors or NGOs, if you're putting the wrong information out there, because that's basically misrepresentation. I think yes, that's the main thing. There's also a reputational risk, because if you become known as a company that puts out wrong information, that misrepresents your ESG credentials, that's a big reputational risk, and people dealing with you will have this at the back of their minds when dealing with you, and may not necessarily even want to deal with you in certain circumstances. And so absolutely, it's a risk. There's risk of litigation. There's also reputational risk. And in some cases, fines and penalties as well. Because if you're looking at some of the acts, some of them contain fines and penalties for non-compliance. And so if you're not doing what you're supposed to be doing, that's a big problem in terms of your bottom line, in terms of fines and penalties, your reputation, and also litigation.
Excellent point. Excellent point. So considering the fact that reporting and also communicating our ESG story will require that we collect data and then report or generate insights from the data, and looking at the nature of our data privacy laws in Ghana, how do you think companies can navigate data privacy laws and also protect themselves against any breaches that may be related to their disclosure of ESG information?
Well, hopefully they're already complying with our data protection laws, because these apply across board, whether or not you're collecting ESG information or some other form of information. It's a matter of making sure that you're obtaining consent where necessary when you're collecting the information, and collecting the consent by informing the subjects of what you're collecting, why you're collecting it for, what you're going to use it for, facts as how long you're going to hold it, or if you're going to be sharing it with other entities. You'll have to get their informed consent before you go ahead and make these disclosures, because without that, you can't make the disclosures and you will be in breach of our data protection laws.
Excellent. So my final question to Lily before I move to Gordon will be, quite a number of business, particularly the members of UKGCC, may have multiple reporting responsibilities. So considering you are operating in Ghana, which has some very strict laws on some of the ESG areas, particularly under the S, where some areas under diversity, equity, and inclusion are pretty much restricted. How then can businesses make sure that their reporting will not put them in a situation where it can offend the laws of a particular land or a particular jurisdiction they operate in, whilst attempting to, let's say, report in line with the regulations of another jurisdiction, particularly if they have a holding company that they need to report to?
I mean, I suppose it's a matter of knowing that you do operate in different jurisdictions, and they will have different legal requirements, cultural requirements, social requirements, but you do have to sort of comply with each jurisdiction's requirements while you're there. So even in your group reporting, you do it's not a matter of choice. It's a matter of having a requirement, having to make these mandatory reporting. It may be a matter of language, making sure the language that you're using is proper and it's not offensive. But as to what you're supposed to be reporting, if there's a requirement to make such a report, you have to comply with the legal requirement to make such a report. Nowadays, we live in a global world, so sometimes it's difficult because we are all interconnected and information is shared so easily, but you do have to comply with every jurisdiction in which you're present. And some will have laws that may be more stringent than others, or even different standards or different diversity requirements. So when you're in England, you report the English diversity requirements. When you're in Ghana, you report your Ghana diversity requirements. And I think we are all sophisticated enough to know that if you're doing a group reporting, there's reporting for each country, which will have different requirements.
Excellent point. Excellent point there. I mean, these are very deep insights shared by Lily Akwe. I think we should be doing this more. The dynamism and the deep insights shared has really enriched the discussion today. So thank you so much, Lily and the JLD and MB team. So Gordon, considering the fact that you are from a tax background and there are a lot of things companies put in place to drive countries put in place to drive compliance of tax laws and also compliance with some specific regulations. Lily earlier on mentioned or cited Ghana's credit downgrade by Moody's in 2021 with specific mention of our ESG ratings. Now we have different regulators who have different ESG requirements, asking different companies in different industries to respond to. How do you think we'll be able to achieve or ensure policy cohesion on ESG at the country level so that this complex challenge where diverse regulations and standards are being thrown about will be done away with? And then if you pick our regulation, let's say from the banking sector, it has some connection with what, let's say, the stock exchange is saying. It also has some connection with what the Ghana Stock Exchange might be saying. And also there might be something like by way of an incentive from, let's say, the fiscal policy side, where people who are able to make investments, clearly compliance with ESG regulations can be expensive. So to be able to ensure this kind of policy cohesion between all these key players, what do you think at the country level should be done, coming from a tax background?
Yeah. Thank you very much, Ken. And Lee, thanks so much for your presentation. That's really insightful. Yeah. So in terms of taxes, as a business, the social aspect, as I did indicated previously, the tax falls under the social aspect. And as a business, you really need to make sure that you are complying, because if you don't comply with your tax obligations, what it means is that you'll be exposed to interest, payment of interest and penalties. And that would also mean that money that you could have used to, you could have invested into operations will be used to pay interest and penalty. And that means that your shareholders will not have enough returns going forward. So the least thing that you want to do as a business is to be paying those interest and penalties. Now, how do you ensure that as a country we have a cohesive regulation that will cover everything that we do in the ESG front? If you look at the tax area, for instance, we have the OECD guidelines, where when you are bringing any tax legislation, you try to look at it as a model. So whatever you do is modeled around the OECD. Okay, so I'm thinking that, as you know, ESG is evolving with time. So with time, it's likely that governments would develop a model regulation that would serve as a benchmark, that every other regulator that want to bring any ESG requirement would have to use that as a benchmark. So if you look at what the Bank of Ghana have done, they have benchmarked their reports around the Equator principles, around the GRI principles, and even sometimes the IFC standard. If you also look at the stock exchange, they are basically looking at the GRI standards. Okay, and I'm sure that very soon other institutions or other regulators will also come up with something. It's likely that if we don't come up and have one one model that government will prescribe and government will be using, then we are likely to have this kind of the joint reporting system, and then you are not able to compare. But if you look at the work that government has done over the years, even at the Jubilee House, there is an office for sustainability, and in the region, in the West Africa region, or even in Africa, Ghana was the first country to come up with a report that we call the Country Road Financing Framework. And that report, for instance, gives a basis to how the country Ghana is looking at sustainability reporting. So I'm sure government need to do a lot in that space. Government itself has to report on what we are doing as a country. And once that becomes a benchmark, different institutions will adopt that, and then there will be some kind of consistency when it comes to reporting. Now, in the area of incentives, what I would say is that the greatest incentive for you as a business is to ensure that you are complying with the target that you have set. Because, as Lily said, investors are looking at these numbers. And so, as a business, you don't want to wait for somebody to come and incentivize you before you do the right thing. If you do the right thing by reporting and achieving the target that you have set for yourself, it means that investors would even be interested in your business and want to put in more money. The other thing is that if investors are not even bringing money, the ones that you even have will be comfortable to stay with you. And that means that your business is even going to have some stability. Your employees will stay with you, as I did mention. Your employees will stay with you. The society that you're working in will all be. So there's enough incentive in terms of business sustainability going forward. Not alone looking at what you are going to get in addition, but the fact that you are going to operate into the foreseeable future just because you are doing your things right is enough for you to do. Ken, thank you.
Excellent point there. So there's a question from the Q&A in the chat box from Nigel Carter. He says he's a former delegate to the ISO in the development of international environmental standards, particularly on greenhouse gas management and accounting and on conformity assessments. So he has some deep experience on the subject matter. He says he's also a former member of the British Standards Institute's governance committee. And his question relates to your reference when you discussed the BOGs and its future requirements of businesses when qualifying them for finance. So this has to do with, if you look at the sustainable banking principles, where banks now have exclusion lists detailing some companies they will not do business with, particularly based on their exposure to environmental risk and other things. So his question is, ESG is increasingly being used, particularly by investment analysts, as a weapon to discourage investment in, for example, tobacco companies, oil companies, aerospace, and defense sector organizations. where military materials are produced. Suggestions are already being made that a shortage of investment is probably affecting Ukraine's war efforts. The UK and Ghana share an interest in securing their own energy resources. Do you think that ESG is a threat to investment in these areas? I mean, the areas that are normally part of the exclusion list financial institutions put up in their ENS risk policies and manuals.
Okay. All right. Thanks, Ken, for reading out this particular. And Nigel, this is a very detailed question. And I'll start off by saying that ESG as it is, there are a lot of myth around it. So a lot of people have said different things about ESG. And one of the things that people are even saying is that ESG, is it something that we should even adopt in Africa? Because when you look at things around decarbonization, for instance, how many industries do we even have in Ghana that are, polluting the environment such that we have to really be paying attention to all this carbon effort and not? So people feel that when we start measuring these things and start being deliberate, we are even going to slow down on our development effort, and therefore we'll still be at the beck and call of the Europeans. But some of these things are still myth, as I said, because whether or not we are producing and we are maybe releasing carbon into the environment, again, we are still seeing the impact of climate change on in our country. So if you look at Ghana, for instance, we had two weather seasons. We have the dry seasons and the wet season. Now you will see that things have changed. If you look at this year, for instance, when we expected the rains to come, it had been raining from somewhere March up to now. Every other day it rains, and then after raining, you see the sun scorching like never before. So you see that the trends are really changing, and so whether we like it or not, we really need to prioritize ESG and make sure that it's into the fiber of everything that we do. Now, the other thing that we need to consider is that although we think that, you may think that this, investing into these areas, ESG would affect you investing into other areas. But what we need to know is that the West is still looking at us, and every now and then we go to them for finance and for some support. So if you don't do your things right, what it mean is that you will not get that support that you need from them. Okay, and if you look at even last year, the report that was coming from Fitch, Moody's, and all that, they were all based on our mining issues, the galamsey issues that we had, and all those things impacted our ESG rating. So that will say that we need to continuously prioritize these ESG things, look at the positive aspect of it. The other aspect that we feel that they are negative as a country, we need to look at how do we move out of that space. But then there are a lot of advantages in prioritizing ESG. And I'll say for us as a country and as businesses and as individuals, let's do our bit to make sure that we prioritize ESG in whatever we do, so that we move our country and our businesses forward in the right direction. Thank you.
Excellent point. So to add a little to what Gordon said, so Qatar wants to find out if ESG is being used as a threat to the investment in these areas. Clearly not. Banks have diverse portfolios that they invest in. So when they have funding from development finance institutions that are geared towards impact investing or sustainable investing, they ensure that those funds are channeled into ESG related investments. But when they have funds that do not have any direct restrictions in line with ESG, then some of these businesses can also have the chance to do business with them. But then, as we always say, much as we would like every business to be sustainable, some of these businesses are also very important as part of the life we live. So the banks also try as much as they can to engage, even for those whose industry may not even permit them to be sustainable. They try to push them to be responsible in the way they do businesses so that they don't get into the news for the bad business. Thank you so much, Gordon, for taking this. So the next question is from Zoe Techi Apia. And the question is, how can companies ensure that ESG obligations required by foreign investors are practical and achievable within the context of the company's operations? Gordon and Lily, any of you can take this. How can companies ensure that ESG obligations required by foreign investors are practical and achievable within the context of a company's operations? Lily, would you like to take a bite?
Yeah, I was going to say on my part, I think it's a matter of discussion and negotiation and engagement, because sometimes it's a matter of the investor coming from outside and not necessarily knowing what the situation is like on the ground in your jurisdiction. So it's also up to you to educate the investor about your local circumstances, because it may be that a requirement that they're asking for is actually impossible to comply with in your local circumstance. So I would say engagement with the investor, negotiation, and also try and show them why whatever requirement they're asking for doesn't work practically on the ground, and look at alternatives or other ways of achieving what they'd like to achieve. That would be my 2 cents for this.
Excellent. Gordon, we want to add something to this?
Yes, Ken. Yes. So, in addition to what Lily has said, I would say that when you look at the practicality of some of these requirements and the work that we have done so far, you realize that for all these funding institutions, when they are coming, they try to benchmark, or they try to ask you to, to report based on some specific standards. So what I've seen so far, sometimes the IFC standards, they ask you to make sure that you are reporting your operations in that manner. So to make it more practical, you need to get an assurance party, to get a third party to really assure the numbers that you have. So whatever you are saying that you are putting out there, even if you say you have done this. I remember the last one that we did. The company then said they have done a lot of things to ensure that their employees, are really secure and safe. But when we did our own survey and the employees were giving us feedback, it was different. So that was not practical. So getting the third party to come in to review and also give you that assurance is very important. And that's what I think that companies need to be looking at. If you want to make sure that you give some practical, information there, then you have to get some assurance party to assure your numbers and your information. Thank you.
Excellent point. So to add to what Gordon says, Zoe, if it becomes a matter of your word against the word of these investors, then they will wield a superpower or more weight over you, because there will be nothing for them to rely on, considering the fact that you need them more than they probably need you. So if you have, or if you get that third party assurance, and it's really not about what you say, but it is what you have said that another person independent of you has also reviewed and validated, then some of the expectations can be really practical, as you are asking about. Gordon, let me read this one out. So I think Lily too can take this. How has ESG changed due diligence, particularly in the mergers and acquisition context? And this is from Nana Sewa Godson Amamu.
Hi, Nasewa. Increasingly with transactions, we've seen the companies having to sort of report their ESG credentials. So particularly for M&A, the companies will likely take on liability depending on if they're merging or they're acquiring another company. There's liability attached to actions of the companies involved in the transaction. And so they like to extend their diligence to ESG considerations to make sure that there's no litigation risk, there's no reputational risk, there's no greenwashing in a number of circumstances, to make sure they're not taking on liability which they shouldn't be taking on. And so a lot of companies have added those to their DD checklists, and we're required to actually look at that focus on ESG considerations and ESG compliance, where the legal and non-mandatory aspects of all that as well. I don't know if that answers your question, Nasewa.
Yes, I think it does. And even beyond the M&A context, there are financial institutions out there who are also looking for business investing. A good number of development financial institutions and private equity businesses and all that, even before they talk to you, they would want to know how sustainable you are, because if they invest with a company that does not give them the promise of being in for the long haul, then they stand the risk of losing their money. So quite a number of these are even paying consultants to help bring their target investee companies up to speed with some sustainability requirements. So quite a lot is changing within the area, right? So there we have about 3 minutes more. So I'll take this question from Akwe Hooper, who's asking that plastic pollution, which falls under the environment pillar, is one of the challenges bedeviling us as a country. what do you think are the proposals of using taxes to control the use of plastics? How can we use fiscal policy or taxation to control the use of plastic waste?
All right. So, Ken, I mean, and Hooper, thanks for your question. I think at this point, I would want to rather look at the 3 R's of sustainability. So, we have the reuse, the recycle, and then the reduce, right? So, when you look at plastics in nature, I would not quickly want to say that we should use taxation to really stop, people from using plastics. But as a country, when it comes to sustainability, you need to really have a way of getting to encourage people to adopt best practices. So if you come to plastics, how do we ensure that whatever plastics we use today, we can reuse them? So if you pick the pure water, the bottled water, okay, what else can we use the bottles for after we finish drinking? You will see that sometimes by the roadside, people have innovatively used them as some of the how do you call it, the the lorry stations. They've used it to do
Yes,
various
as
things.
trash
Even if
bins
you
and
look at
cans.
car
Yes.
ties, some restaurants, you go to some restaurants and they've used the ties to do some tables and things. So I think we should rather go into this, and this will even create more employment for the youth, another avenue for employment. When it comes to even the recycling aspect as well, how do we even use some of these things to do compost, even for agriculture, to transform the farms that we have? So I will not really quickly go into the tax aspect, the tax area, because already we are complaining about the taxes. But again, tax becomes one of the easy ways that we want. But we don't always want to go to the easy way. We want to find other innovative ways of doing this. Now, if you look at the UK specifically, when you enter a shop, for instance, and you want to buy something, eh, they give you a paper bag. If you want a rubber bag, you have to pay for it. By paying for it, they are dissuading you from using it. So they give you a smaller one, which is a paper bag. If you want to use a rubber bag and you request for a bigger one, they ask you to pay. And if you see the amount you pay for certain, you will stop using it. Okay, so I think these are some of the things that we can do, but rather using taxation sometimes is a bit harsh on our people. Thank you.
Wow. Excellent discussion here. The level of depth and insight shared, the dynamism that comes from the experiences shared from the legal side and also from the practice side with Gordon's tax experience and ESG practice has really enriched this particular session. And I hope our participants who listen in have really made some notes, and we believe that moving from here, they will be in a position to, at least those who have not started anything at all, begin something. And where you need help, reach out to the consultants who have been on this call to support you with the insights they have shared. So thank you so much, Lily Akwe, a partner from JLD and MB, and also Gordon Dade, an associate director from KPMG Ghana. So I'll hand this over back to UKGCC, and I'll be your moderator. My name is Kenneth Ejedia from KPMG. Thank you.